Hey there, welcome to episode 50 of Money Never Sleeps, a podcast that looks inside the head of entrepreneurs and at what makes them do what they do. I'm Pete Townsend, your co-host of Money Never Sleeps, along with Owen Fitzgerald, who took the mic solo this week for an onstage chat with Pascal Bouvier as part of the NattyFin Accelerator week's worth of activities and events in Dublin. This episode of Money Never Sleeps is kindly sponsored by Ireland's fintech and financial services recruitment specialist, Top Tier Recruitment. If you or a colleague need help attracting and retaining great talent for your fintech or financial services company, we highly recommend you have a chat with the team at Top Tier Recruitment, as they really know their stuff. You can find them at toptierrecruitment.com and tell them we sent you. In this episode, Owen talks to Pascal Bouvier, managing partner at Middlegame Ventures, a venture capital firm focused exclusively on early-stage fintech startups, and Pascal is also one of the leading voices in fintech on both sides of the Atlantic. The first time I read about the kinds of tech companies that Middlegame Ventures believed in, I got very excited, as their focus is smack down in the middle of my sweet spot, but more to come on that in the coming weeks. Pascal sat down with Owen this week in front of a full house at a NattyFin Accelerator event at the brand new offices of the Banking and Payments Federation in Ireland on Molesworth Street in Dublin. I missed the gig, but our soundman Conan Brophy recorded the chat so that I and all of you out there in podcast land can get to know Pascal and his modus operandi right here on episode 50 of Money Never Sleeps.
Pascal, actually, we were chatting this morning, and I actually was in the audience. It was 3 years ago now. You gave a talk over here in the NDRC, and that was the first time I actually had the pleasure of meeting you and listening to you speak in person. I'm obviously an active follower, as many of us are, on Twitter and LinkedIn, of all the stuff that you put out.
Thank you.
It's always interesting. Can I ask, the last time you were here?
Just as an aside, I remember that time 3 years ago. It was at the NDRC.
Yep. It was a pre-accelerator.
I was invited by the Bank of Ireland to speak. And I introduced myself in a very fateful way by saying, if that gentleman, Donald Trump, wins the presidency, I probably am going to move, and spend more of my time in Europe. And I had a big rise out of that. A lot of people were laughing. So if I were an imprudent man, I would say, if Trump gets reelected, because we're in the process of the presidential election cycle, maybe I'm going to get the Irish residency. I don't know. But I'm not imprudent, so I'm not going to say that.
Of course not.
Right.
We were here, or you spoke in Dublin a couple of years ago, and at the time you were talking about the second wave of fintech. And I suppose it was more things moving towards collaboration. Would you say now, based on what's happened in the last 3 years, that we're on maybe the third wave?
Oh, probably the fourth, the fifth, or the sixth. If I remember correctly, right, I was referring to a second wave, or maybe at that time a third wave, given that the first wave was all about direct-to-consumer disruption, mostly coming from the Silicon Valley or emanating from the Silicon Valley, and copied in various geographies. And it was obvious that at the time that wave had somewhat failed to disrupt large financial institutions and incumbents. And as a result, a lot of startups that had raised capital in order to survive were pivoting to collaborating rather than competing, right? So B2B pivots and B2B2C pivots, and helping banks, insurers, asset managers to digitize themselves. I think we're definitely past that pivot and that wave. And it might be surprising, but I was actually with my partners, Michael and Patrick, who are on the side. I was talking about that earlier today, right? It feels that we've gone through like a major hype, like the Gartner hype cycle, a major hype of everything fintech and disruption everywhere, and banks are going to quote unquote die, and after the banks die, that's going to be the insurers and so on and so forth. That didn't happen, and we had a kind of a trough of disillusionment because there was not that much traction, and it feels and it seems that large financial institutions are very certain that they are going to survive yet another day. But to me, right, observing the various things that are happening in different markets, it does feel that there's starting to be some type of disruption. It's very slow, right? We're dealing with money. We're not dealing with the pictures that we are sharing on Facebook, and it seems that we're very liberal with that. The psychology of money is very, very different, but there seems to be, some type of change that is taking hold, and none other than in the payments industry. You have a plethora of payment initiatives, of different ways of paying, whether it's direct to consumer for retail individuals, or for SMEs, or for corporates. So a Cambrian explosion of different types of payments and means of payments. And then there's an explosion of currencies. Right, we're dealing with a world of like one fiat currency per country, and now we have potentially central banks that may issue a different type of digital currency. You have commercial banks that may issue their currencies, and they do so in the normal course of credit. You have companies that are going to issue their currencies, i.e. Facebook. You may have communities that do so. So like an explosion of currencies as well as an explosion of payment means. And to me, that means, we have a lot of choices. And then there's going to be middleware that builds on that and, and glues everything together, whereby it feels like large financial institutions, may cede a certain market power with regards to payments, and the activity of payments will take place outside of large banks. That's a potential future, and I'm starting to see this. And that would be like a major, major disruption and major change.
And do you see, so even though we've come from maybe the second wave to now the fourth or fifth, we're still early in the cycle because, I know that the thesis for Middlegame is around a lot of the innovation happening in the back office. So you see innovation, in the direct-to-consumer space, but actually the more innovation that happens in the background for financial services will potentially drive even more innovation at the front end.
Yes, for sure, right. So we're seeing more and more solutions being built off of the middle office or the back office, middleware and back end. And that's actually necessary, those B2B solutions to upgrade infrastructure, to upgrade standards, are necessary for any type of direct-to-consumer disruption. And that's indeed where we are focusing most of our time, because it's probably less risky for us. We're probably more comfortable with B2B solutions builders as opposed to direct-to-consumer builders. And again, right, a necessary upgrade of infrastructure for an industry that globally is anywhere between 15 and 17% of that GDP, depending on where the global economy is. So that's like trillions and trillions of dollars, and it takes time. It's not something that you're going to do within a couple of years, even within 5 or 6 years. Our thesis and our investment activity is over the next 20 years or so.
And you mentioned payments and the future of payments, and there were some even interesting announcements this week. You had Amazon coming out with a credit card or a card aimed at building the credit scores of customers, and then you had Alipay, I think, announced that it had 6 European partners. So,
and Apple.
An Apple Card, obviously,
the Apple
as well.
Card.
Yeah. So where do you see, or I suppose, where do you see payments, and how do you see those players and non-financial services companies playing or having a large role in that space?
Right. It's obvious that those big tech companies are nibbling, and trying to take market share of different types of financial services and products, none more so than in payments. So I always try to go through an exercise of how a particular market and market structure will be in, let's say, 15 years or 20 years, as a focal point, right? And so for payments, my focal point is a digital wallet that everyone is going to have, off of which you will pay, transact, make micro investments, have all your assets off of your smartphone, or maybe it's a different medium. It's like your watch. I don't know actually what the hardware medium is, but that digital wallet that allows you to choose on the fly any type of payment that is offered to you if you go to a retail store, if you're buying something, or if you're online, or if you're a business and you're trying to procure a service. From a payment perspective, that's fairly liberating, right? You have a store value, And then you have the ability through middleware and connectivity of like choosing anything that is offered to you in terms of like how to pay. And then the digital wallet will hold any type of currency, whether it's a fiat currency or whether it's a cryptocurrency, if you're so inclined, or whether it's like a private currency, if it's like a Facebook. And so it's storing all these things, and you're not only choosing how to pay, but you're choosing with what to pay. And then you may also have, assets that are not necessarily, presented for the immediacy of paying something or agencing something, but it might be, and it might be. So that's very liberating because it means you're in control, right, of that part of your deposits or of your net worth that is used on a regular and daily basis. I think that's a fairly profound paradigm, because right now the paradigm that we're used to and that may be changing, that's kind of like the thesis that I'm trying to flesh out for you, is that store of value for most of our deposits throughout the year, right, is the checking account. At a retail bank, right? It's not very dynamic. It actually is protected, thank God for us, because it's very safe. But it's not very dynamic in terms of what we can do with it. So it would seem to me that, one, we're moving towards that. Two, banks need to seize that moment and try to upgrade themselves in the customer experience and the flexibility to allow their clients to transact in every which way. And three, if banks do not do that, then you're going to have, to your point, big tech companies that seem to be innovating at the speed of light when it comes to financial services. If anyone has seen, the announcement that Apple has put out with the Apple Card in partnership with the Goldman Sachs, I think that's a bit of a paradigm change, potentially. Right? It could have a big impact on how we view payments and how we view a wallet and how that wallet is being used on a daily basis.
And do you think in the future or in the near future, it'll be a case that there is one home? So whether it's like a WeChat sort of model whereby everything is within one app, whether it's connected through the likes of open banking, or would there be one place that you go to get the majority of it? If it's either your bank account or your bank app, that's your primary wallet, or will it be a tech company?
Yeah, I think that the connectivity is way more important. Being able to move in and out of various ecosystems as opposed to be, beholden to one. You mentioned the WeChat. That's like a very different universe, right? Born out of a regulatory regime, a way of managing data, and a way of circumventing, existing financial infrastructure, or circumventing like almost inexistent financial infrastructure that we're not used to. I mean, it's like the world of China, and I'm not sure that the industrialized world, whether it's the U.S. or Europe, would move towards that. I'm questioning that, in as much as it feels that there's been a switch in, sentiment towards somewhat a negative stance with regards to big tech, and somewhat a positive stance towards privacy, and that the WeChat example means there's very little privacy. There is very little protection of individuals. It doesn't feel that it's in our European or United States culture to move towards that. I might be wrong, but
maybe Facebook could be that equivalent, do you think?
They might. I think that they have Facebook has an uphill battle with regards to all the things that they have done with our data. Actually, I don't have a Facebook account anymore, but it feels that the heat is being put on these big tech models that are advertising driven, and that might mean that they would cede power to other giants. Maybe banks will seize the day, right? Banks were afraid of a big tech and all the initiatives in financial services, and all of a sudden there's like a sentiment shift against big tech, and that might net relatively speaking, be of benefit to banks.
And do you think, because obviously the challenge from the bank point of view is that as much as they're looking to engage with fintechs, as many of them are failing. I think Finn this week was with Goldman Sachs. That didn't work out, but it was seen more as a channel as opposed to a wider kind of cultural focus versus the Marcus kind of model whereby, they've built up a couple of billion of deposits alone over the first 18 months. So is it needs to be a top level view to really engage with the fintechs, or are they
I think like innovation and change in financial services has very little to do with technology, and that has all to do with the culture and governance and intent. So it's a perfect example, right? Like the JP Morgan approach and the Goldman Sachs approach in the United States are very, very different in terms of what they want to achieve from a digitization point of view. And we don't have like direct evidence, but it feels like the branch network of JP Morgan Chase won that battle, either implicitly or explicitly. And Finn, which is a pure digital banking app, lost, right? Yep. I think that, when that was announced, there was also a doubling down on we really are gung-ho on our branch network and we'll open more branches and so on and so forth. It's like compared to Goldman Sachs that went all in, abstracted their pure digital offering outside of Goldman Sachs, hired marketing people, advertising people to kind of build a business from the ground up without any type of interference from the mothership. There's like a cultural design that says we want to completely reinvent ourselves instead of like tinkering at the edges to kind of augment what we already have. And I would say that there are few banks in the world that have that Goldman Sachs approach. There's the DBS in Singapore that is very, very good at digitization, and they're quite advanced in their markets. If you look at the DBS's annual shareholder report, and that has been the case for the past 6 years or so, you have actually pure digital KPIs that they compare to physical branch KPIs. So a digital customer, has this type of ROI, and there's this type of cost of acquisition, and it's much better than like the traditional customers. That approach is like fundamentally different. In Europe, I think I would say that ING and BBVA to a certain extent are quite advanced. Goldman Sachs obviously in the US, a couple of other smaller institutions, but comes from the top for sure.
And you were talking earlier about, or when you were doing the introduction, about currencies and fiat currencies and global currencies. Where are your thoughts on the future of money, I suppose, over the next couple of years?
That's a trap question. I do believe that we're going to have a multiplicity of currencies available to us. I mean, Facebook is just one example. It's so cheap and easy to craft a new type of digital currency these days. And then the border or the line between what is a cryptocurrency or a digital currency and what is a crypto asset is kind of thin. I don't think it's still moving, and I don't think it's been defined. So having all kinds of tokens or representation of something of value, right? Whether it is fairly liquid or whether it is less liquid, is going to come towards us, right? How assets and how monies are represented and are issued and then are managed, used, invested with, and serviced is going to change. And I think that's a major, major paradigm. It touches on capital markets, it touches on asset management, and obviously, day-to-day payments and clearing and settlement of whatever we buy to ingest or we invest to hold. And probably that's a theme that not many people fully understand, right? Because we've been so focused on lending and robo-advisory and savings and some directives, i.e., what PSD2 and GDPR are going to do to the financial services industry, that we haven't spent enough time on the capital markets industry and the asset management industry, the sell side and the buy side, the issuance and the servicing and the managing of all these assets that we have. Some are like physical assets, some are really advanced asset like Apple stock, which is fully traded and electronic and so on and so forth. But others are very, very illiquid or not efficiently issued at all. And that will have profound impacts on everything that we do. When I mentioned, you'll have a digital wallet. That digital wallet may have a lot of assets that you'll be controlling at your fingertips, right? That's kind of like an interesting focal point to mentalize, as opposed to all the assets that you have are kind of like balkanized and reside in different repositories with different custodians and so on and so forth.
Because to me it would seem like, from a practical point of view, it is easier to see a world whereby there's tokenization around assets as opposed to digital or cryptocurrency, and we're all using that. It's an easier leap in my brain, I suppose, to make to digital and tokenization of assets and asset classes than global currency, digital currency, and the challenges that would be around trying to bring that in.
Yeah, that's a fair point. I think that tokenized securities, i.e. adding some type of cryptography or automation or code to an asset that we're familiar with, right? An equity, a bond, some real estate. And these are like evolutionary baby steps, and it's fairly easy to kind of envision that path, that evolutionary path, to think about pure digital tokens that are endogenous to a specific protocol, right? Whether they're assets or whether they're currencies, that's more science fiction-ish. It's kind of like more difficult to think that it's going to be with us tomorrow. It may or it may not. Interestingly enough, there is a startup that Michael and I invested in with our previous fund, based out of London, called Clearmatics. I don't know if some of you have heard of Clearmatics, but they are working on a stable coin, right? That's a dirty word. Right? That is backed by central bank reserves, right? Bank of England reserves. Wholesale stablecoin that will allow for netting and grossing, basically clearing and settlement of payments and change of and transfer of value between large commercial banks and the central bank, the Bank of England. That's fairly revolutionary, right? That famous venture capitalist in the Silicon Valley, right? Said software is eating the world, right? To think that software is actually eating a currency, and that a currency, be it a wholesale currency, is going to acquire some type of programmatic quality, right, with some code, so that more is being done with it and with its representation between various actors. That's a paradigm shift, right? And it probably is the first step towards having, that being unleashed on us poor and suspecting retail clients. That probably is, further along in the future, if it would ever come to that.
And let's talk about an area that gets a lot of, I suppose, more than the average amount of focus in terms of fintechs is around the kind of challenger banking space. I was at Money 2020 last week, and they had back-to-back talks from WeChat, and actually the really interesting one was from the CEO of Kakao, which is, for anyone who doesn't know, is a digital bank in South Korea, and they've talked about in the last 2 years they've now turned profitable after their 7th quarter in operation, but they have 9 million customers, but they have 15 billion on deposit, which is incredibly unusual for challenger banking space, I suppose. How do you see that play out from a European context in terms of some of the big names that are out there, and how is that going to look in a couple of years' time?
Yeah, it's a good point. So remember what I said earlier, right? It felt that we were disillusioned with any type of fintech disruption. It was not happening. And then, there's kind of hope, at least from what I see. There's things that are happening. Those challenger banks are like the perfect example, right? So there are several in Europe that are now claiming, million or over 1 million clients. I think Monzo is
past 2 million now.
Past 2 million, but they're like signing 60,000 clients a week. I don't want to misquote. It's something that I read recently. And that's quite staggering. And I would say that that's a movement that is not limited to challenger banks per se, i.e. startups that are banks that got a banking license, right? You have many other services, apps that started and unbundled one particular piece of a bank offering, right? And are now rebundling and trying to, by regulatory arbitrage or skirting, bank licenses, trying to deliver all kinds of bank services that a traditional bank would offer. So a couple of examples. Like Robinhood, which is a brokerage trading app in the U.S., is a perfect example. I think Raisin here, that is not necessarily a challenger bank, started with basically deposit brokerage as a marketplace, is adding services. So all of these startups that have reached a successful or enough scale in terms of way more than a couple of 100,000 clients, and are thinking about okay, let me add product or service number 2, 3, 4, 5, 6, right? So a lot of challenger banks with licenses, a lot of startups that don't have licenses and are perfectly happy with that because that's their strategic choice, but all of them are nibbling and taking market share from the traditional banking system. So I was not positive at first because I thought that these businesses would be really capital intensive. The cost of acquisition would eat at them. And I'm starting to turn around and to the point and the venture point where, there's something there. There is... I didn't coin this. I wish I did. There's a analyst and consultant in the fintech world in the United States that did so quite brilliantly. He coined the term deposit displacement, right? So more and more of us in the aggregate in various countries are placing the monies that used to end up in our checking account, a traditional primary checking account, in a variety of apps, whether it's the Starbucks app, or the Nero app, so that we're able to buy our coffee every day, whether it's the Robinhood app in the U.S. or the equivalent in Europe, whether it's Amazon with a reloadable card is a perfect example. So there is less monies that are staying in traditional checking accounts, and these monies are staying less time in that checking account. And it's being displaced either before hitting the checking account or after hitting the checking account with a variety of apps. I think that also has a profound impact. And I would say that it's part, directionally so, of what challenger banks are trying to do.
But you mentioned deposits there. That actually has a bigger impact in some ways than losing market share for a bank then, because actually losing the deposits, whether they're going to a challenger bank or to a Robinhood and to a Starbucks account and all of the others, has a more profound effect possibly on a bank then.
I would say so, yeah. I think that the deposit displacement, the checking account is the nexus, whether it's a wholesale checking account and you call it differently, or if it's a retail checking account, right? That is the cornerstone of what builds a banking business. So if a bank loses some type of power, and everything is relative. It's not like tomorrow there's a complete loss of control, right? But, relatively speaking, if you lose a little bit of that control, whether it's on the monies that go through the account, or whether, more importantly, it's, the data that is embedded data that is associated with that account, then strategically speaking, you're ceding power to either new entrants, be they pure startups, new entrants, be they big tech companies, and that long term, that's not a strategic position that you want to be in.
And do you think it'll lead to even more acquisitions or partnerships? I would imagine it'll have to, because
who acquires whom?
Well, I suppose the question is who wants to acquire whom, because I would imagine that the easier solution is the bank buying the fintech, but because the fintech doesn't want to necessarily go the other way and have to acquire the bank and the license and all the regulatory challenges.
Sure.
But I mean, there's very high valuations on a lot of those companies as well. They're not an easy acquisition.
So I definitively so. I don't think that I can answer this. I think that there's like different scenarios that may or may not happen, and you have to ascribe certain probabilities to these scenarios. So like a number one scenario is like, things lead to most banks becoming utility pipes and utilities, right? And they see the distribution and the power that they have through the distribution to someone else. Not that they wanted to, but one thing leads to another, one strategic error after another, and then it happens. Which means that the return on capital and equity of most banks will stay as low as it has been since the 2008-2009 crisis. That's potentially a scenario that could be played out. And another one could be, big tech fails just because there are so many societal issues and there's a backlash from a legislative point of view. And so banks, relatively speaking, will get back that market power and be able to either acquire the assets that they need to compete effectively in the digital world. That's a second scenario, I would say. How to game probability-wise these? I think that your bet is as best as mine right now.
I'm conscious we have you here, so I'd like to put it out to some questions if anyone has any. I'll get the opportunity to ask you. Richard?
Hi. Been a lot of talk about the main challenger to banks coming from big tech.
Yeah.
Big tech. But would you not see, given things like the trust issues, are the real threat to banks not other banks? Other banks actually learning the tricks of the bigger tech and more nimble, and then them eating into existing banks? Yeah,
certainly so. I think that someone said very aptly, actually, right? I think it's a fintech consultancy in the UK, right? It's only 1% of the digitization or the disruption has happened in the financial services industry, i.e. there's like so much more to happen. And then someone else that I know said, yeah, that may be true, but like 30% of the time has elapsed already. Which means that 1% of like progress is extremely unevenly distributed. And I mentioned, various banks, BBVA, ING, Goldman, DBS. There's like a smaller outfit in the US called USAA that I think is very good at digitization. There's obviously Capital One. There's probably a couple of other examples in Europe. These are the ones that, given that they're ahead, and assuming that they will continue remaining ahead if they don't make any strategic mistakes, are the ones that will have the potential to either acquire other, weaker competitors or survive by just gaining organically market share. So that's very, very, very true. On top of that, it seems to me that there are certain types of legislations, as well as the regulatory framework that everyone works under, that usually benefits already large institutions, right? So what legislators and regulators want, i.e. a market structure that is a little more even, with like mid-market firms to make, for a competitive landscape that is healthy, might not happen, and you may have like more market concentration. And that market concentration will flow towards those banks or asset managers or insurers that were able to seize the day earlier than their brethren. So I would agree. Anyone else? Yes.
Pascal, two questions. First of all, internet fees. When is my fridge going to be hooked into my digital wallet so I can see when it's paying for my wine? And then in terms of security solutions, when are we going to start seeing innovation in terms of security? Because really, let's say all these innovations with respect to payments or consolidation of all these things, we really need to see security solutions that are on par with cybercrime to actually make things real.
To your first question, I was about to say never. And then you said wine, so I said, I hope tomorrow. Your second question is related to your first question, right? The Internet of Things is completely, that universe is completely insecure. So I certainly hope that none of the stuff in all of our collective houses will be connected to the Internet, because that's like a complete nightmare. I don't know, who has like a Alexa in their homes or their, please disconnect it immediately. I mean, come on. Or like your, fire alarm or smoke detector. That frightens me to no end. To the second one, I'm going to plead ignorance. The cybersecurity aspect, or at least that universe, is a universe that we know less. So I'm not sure that I would be able to give you an appropriate answer. Yes?
Yes, what advice would you give to startups in the fintech space that is different to the advice you might give to startups in other sectors? I guess I've seen startups trying to sell. I would say your runway should be 36 months, not 18 months, for example. What other kind of pieces of advice would you give to, I guess, some of the guys here, but also...
Right. So obviously fintech is a portmanteau word. There's the fin and the tech. And some startups are more tech than fin, and the others are more fin than tech. But very few really have a good understanding of regulation and compliance. And I mean that in two ways, right? Either regulation and compliance impacts them directly, or it impacts the customers that they're trying to sell to. Either way, it's extremely important, and I don't think that enough attention is paid to these things. Because let's assume that you're not regulated, you don't need to be compliant, but the bank that you're selling to is, right? If you don't really understand how the bank operates, it's going to be very difficult for you to sell to that bank in the right way and to please them as a customer. So that probably would be my number one thing. Every other aspect that I would tell an entrepreneur to look at is probably not specific to fintech per se, but the regulation and compliance aspect, most definitely.
Hi, Pascal, Joe Buchanan. Just touching further on regulation, what about the fragmented global regulatory landscape? Will that act as a bit of a challenge for the tech?
Yeah.
Big tech eating into market share.
Do I have permission from my partners to be really science fiction-ish? All right.
The floor is yours.
I have a undebated thesis that says that we're potentially moving towards a balkanized and fragmented global financial system, right? Whereby the kind of friction that we're seeing between the U.S. and China may not be temporary. It might be something that is longer term, and it would be easy to figure out that we may have like a U.S. and U.S. dollar driven financial system, and the yuan and China driven financial system with their separate infrastructures. I don't know where the EU would fit in there. And the reason being, these become geopolitical issues really, really fast. And if that happens, we're going to have, a more permanent balkanization of financial systems, which means that regulation won't tend towards more harmonization between these different blocks. So I think that it's not complete science fiction to think in these terms and to kind of like prepare. I.e., if you're selling to different global markets, you have to think about adapting your technology solution so that it fits these different markets. Whether it's privacy, whether it's like connectivity with APIs, whether it's where your technology resides and what type of cloud infrastructure. All these may make the life of fintech service providers that try to be global more difficult. And financial institutions too. Think of a financial institution that has a lot of commercial interests in Europe or in the US, and also in Southeast Asia or China. If things don't go towards more peaceful harmonization, you're going to have life choices. Yes.
Hi. In the context of China, or if you look at Tencent and Ant Financial, they've come to command almost 90% of the market share of mobile payments. We haven't really seen that model in the US, and I was wondering why is that the case? I mean, if you look in the context of the top 10 global banks in terms of capitalization, at least 3 of them are Chinese, and they barely own any of that transaction.
Sure.
But in the US, that model hasn't been replicated, given the fact that the US is quote-unquote technologically more advanced. I'm just intrigued why the disconnect where China led it, but the US is nowhere close to that.
Yeah, that's a very difficult question to answer, I would say, right? There's probably political intent. The Chinese Communist Party, which essentially is the government, has an intent on, building giants, and helping from a regulatory standpoint might be one explanation. Another explanation might be, the U.S. is so driven by credit, and there's such, a legacy infrastructure for credit, and credit impacts payments. It's very difficult to dislodge this with instantaneous new generation of payment apps that take on close to 90% of the market with new technologies, i.e. QR codes. And so I think that there are legacy technology issues, cultural issues, and then political issues that would explain that.
We actually have to cut it there on direct questions. But I just want to say thank you for your time.
Thank you.
As always,
Thank
it's
you,
always
everyone.
interesting.
Money never sleeps, pal.
That wraps it up, folks. Thanks to Pascal for opening up his mind to help us figure out why he does what he does. Remember, if you or a colleague need help attracting and retaining great talent for your fintech or financial services company, get in touch with the team at Top Tier Recruitment, as they really know their stuff. You can find them at toptierrecruitment.com. To learn more about Pascal and Middlegame Ventures, you can check them out on middlegamevc.com or follow Pascal Bouvier on Twitter. That's PascalBouvier. I could spell, folks. If you like what you heard today, please subscribe to Money Never Sleeps on iTunes and leave us a 5-star review. You can also subscribe via our website to channels like Spotify and Stitcher, so just go to the subscribe page on moneyneversleeps.ie and follow the links. If you're searching directly on iTunes or Spotify, Money Never Sleeps is spelled as all one word. For more info and links, check out the show notes on moneyneversleeps.ie. You can drop us a line on info@moneyneversleeps.ie or at MNS Show on Twitter. As for me, I increase the odds of startup success. DM me on Twitter at Pete Townsend NV if you want to know more, and you can follow Owen on Twitter at OwenFitzgerald9. Finally, thanks to Conan Brophy from Create Sound for recording and editing this podcast. Till next time, thanks for listening. See ya.
Money never sleeps, pal.